Welcome everyone, and thank you for taking the time today to tune in and watch this video presentation. My name is Brandon Van Landingham, Chief Investment Officer of Paresis Private Wealth Management. And what I want to talk about today is our approach to manage portfolios, kind of go over some of the believable misinformation or myths that you'll often hear quoted in either financial media or through financial salespeople. And then also talk about the different phases of your investment life cycle, the difference between the accumulation phase and the distribution phase, and why we believe you should manage money in two different ways for two different styles and parts of your life cycle when it comes to investing. So first, let's talk about the accumulation versus the distribution phase. You know, you've always hear one of the believable misinformation that's out there is, the market's always good over long periods of time. If you look at the last 100 years, the market's up 6% per year for, decades. And that's true, but most of us don't have that 100 years. And we'll get into that a little bit later. But first, I just want to talk about when you're accumulating money, when you're working and you have a 401k plan or an IRA or any other form of deferred taxes, what you typically see is dollar cost averaging into your portfolio. You're very disciplined because you don't see it, you don't pay attention to it. It starts out small, it grows over many years. And the key to that, and the reason why that happens, even if the markets go through big cycle downturns or secular bear markets, and that is because the discipline, the constantly buying shares, when the share price falls, you're actually accumulating more shares, and then when it does rebound back up, you've amplified your return. So here's an example of that. Say you're going to be disciplined and you're going to invest $1,000 a month for 5 months. So that's a $5,000 total investment. And the stock that you're going to buy every single month today is $1,000. So today you buy one share for $1,000. The next month it falls in half. And so at first you're probably a little shaky, a little worried about it, but you go ahead, you're disciplined, you just do it. In a 401k plan, this happens automatically. You don't see it, so you don't notice the value falling and you don't notice that you're buying more shares. You just kind of look at it maybe quarterly, semi-annually, or even annually. So in this example, it stays down at the 500 in the third month, so you buy 2 more shares. Then it falls even further. It cuts in half again, so you buy 4 more shares. And then it starts rallying back. So it only makes it back to $500, still half of the initial amount, and you go ahead and buy your 2 shares. At the end of that 5 months, you have 11 shares. At the $500 price, that's $5,500 versus the $5,000 that you've invested. So you look at that and it almost doesn't make sense. You've made 10% when you've only put the 5,000 in, but the market is cut in half. That particular stock's still not where it was when you first started investing in it, and that's the power of dollar cost averaging. Now let's look at the distribution phase. So in the previous phase, the accumulation phase, this is more of a passive investing approach, and even I recommend that. When people ask, well, I know you're a portfolio manager and you know how to pick stocks, and you believe that there are times to be in the market and times to be out of the market. And then they'll hear me, it's almost like they think I'm a hypocrite, because then I'll say, well, what you need to do, you've got 20 years till you retire, put as much away as you can, and continue to dollar cost average into your 401k or your IRA. Over these next 20 years, you'll do a whole lot better by buying those shares and just continually to plow away. But whenever you retire and you move from the accumulation phase to the distribution phase, and I always tell people to start looking in advance, 5 years in advance before retirement, changing over your investment strategy in order to maximize that retirement income stream. And so when you're looking at the distribution phase, a lot of people kind of think, well, if dollar cost averaging worked, how does that work on the reverse side? And the thing is, on the reverse side, it does exactly the same thing. It's just in reverse. So when you look here, I just kind of built this fake portfolio, $500,000 portfolio, and we're going to say the entire portfolio is worth $1,000 of shares, so we can match the last example. So you own 500 shares now. So over all these years, you've accumulated 500 shares, and it's worth $500,000. So now you're going to need to take $1,000 a month out. Instead of contributing 1,000 a month, you're going to be pulling it out. So you're going to have to sell shares. So in the first month, the value of that portfolio is $1,000, and those shares fall, or you sell one share, takes you to 499 shares. Then the value of the portfolio per share goes to $800. So you take out 1.25 shares. And then the portfolio falls in half, just like in the previous example. And then it bounces back to 750, and then by the fifth month, the last month of this example in the distribution phase, it's at $800, so you go ahead and pull out your 1.25 shares. So the total shares that you have left are 493 shares, 0.17. But let's just assume that you're not taking any more out, but the value of that portfolio is now back to $1,000 per share. But you've been reverse dollar cost averaging out. So when you take that $1,000 per share and you multiply it by the number of shares you have left, which is the 493, you have a portfolio value that started out at 500,000, is now 493,170, but you've only pulled $5,000 out. But your portfolio is down $6,830. And when you look at it, it really doesn't make sense, because the $1,000 is now worth back to the original value. But during those times when the market did sell off, you actually had to sell more shares in order to reap that same $1,000 benefit that you're needing, or that $1,000 distribution. So therefore, you've destroyed wealth on the reverse dollar cost averaging side out of it, the same way that you increase wealth or compound wealth when you're dollar cost averaging in. And that's a big difference, especially when you look at it over many years. You know, $5,000 to the 6,830, you know, that's another $1,800, which is 36% more than the $5,000, right? So that's just the difference of accumulating versus distribution, those two different distinct phases, and why I believe in the distribution phase, it pays to be an active or a tactical portfolio manager in order to try to minimize market downturns or increased volatility over time. Now, again, going back to that believable misinformation, the market is always good in the long term. And in the long term, when you think of it from that example or that perspective, then it's true. I mean, it has averaged, 6 to 7% a year over, say, 100 years. And Ibbotson uses an 80-year average. But the thing is, that's great if you're a redwood tree or Arctica Icelandic clam, because they have very long life expectancies. But here's the thing. Most humans have a good 15 to 20 years to accumulate their retirement. Now, you may be accumulating for 40 years, but the last 15 to 20, your career's peaking. You're probably making the most that you've made in your entire career during that time. Your kids are off to college. Some of them graduating college. The house is getting close to paid for. It is paid for. So you're really able to accumulate in those later years. But the thing is also, you've only got 15 to 20 years to accumulate, to plan for another 20 to 30 years to pull from that. So the accumulation phase, 15 to 20 years at a maximum level, and then 20 to 30 years in the reverse dollar cost averaging distribution phase. So the key here is, even though the market has on average been, quote, good to investors, there have been several periods of 15 to 20 years where the market has actually lost money. So when you think about it, if you retired, and just think back to that previous example on reverse dollar cost averaging out, and just visualize retiring in 1929. Well, that's an anomaly, right? In 1929, it took 25 years for the market to break even. But in that same time, you were dollar cost averaging out. You were taking money out of your portfolio, so it amplified that. So more than likely, you were back to work. 1966, that recession or market sell-off took 16 years to break even. 1973 took 10 years to break even. The current market sell-off, or a secular bear market, started in 2000. We rallied all the way back to break even in 2007, sold off again, broke even again 13 years later from the beginning of 2000. So again, someone that retired in the 90s, late 90s, 2000, more than likely, if they were having to pull money out of their retirement account, they either had to reduce their standard of living, go back to work, one of those two things. So here's kind of what it looks like on 100-year, or over 100 years, going back to 1897 on the Dow Jones. And I just wanted to kind of show that we've had 4 bull markets during this time, as well as 4 bear markets, and these are secular bear markets. These are long-term trend changes. And as you can see, I've marked there the Great Depression. So going back, the markets, when they do rally, a lot of times the rallying part of them, the bull market, is a little bit shorter than you can see the average there over the bear markets. 25 years for the Great Depression, 18 years going back to the early 1900s all the way to the 1920s. Then again in the 60s all the way to 1982. And then the largest bull market in history, 1,000-year cumulative return going to 1982 to 1999. And then this chart stops in actually, I think, 2009. And so it's actually back above the red line currently in 2015. But you can see, I mean, over all these years, 70 years here, we're in bear market territory. So whenever you think buy and hold works, in reality, it depends on what type of market you're in, and the only way you know what type of market you're in is hindsight, which is a behavioral bias. If you study behavioral economics, something that I've loved to do for the last 10 years, you'll realize that we suffer from all these biases, and one of them is hindsight bias, to where we look at the chart and it's easy to see those trends in hindsight, but when they're unfolding before your eyes, we become very myopic, very focused on the short term, and oftentimes neglect the longer term trends. So another myth, or another thing that I constantly hear, and clients that come in sometimes will tell me, well, I've always heard that if you miss the 10 best days, I mean, your portfolio gets, destroyed. And that's true. If you miss the 10 best days over this chart is 1978 to 2008, a 30-year window there. If you miss the 10 best days, your portfolio is down 15% over that time period. But that's, again, it's a way to get a point across, but there's two sides to that story. If you miss the 10 best days, your first question should be, well, what about if I miss the 10 worst days? Or what if I miss both, the 10 best and the 10 worst? Or what if I'm in during that, which is a buy and hold strategy, right? So I always tell people, if you want a great book to read Think Like a Freak. These authors were economists, and they really break down the way we should think instead of being biased towards confirmation. As humans, we always look for things that agree with ourselves. If we actually look for things that disagree with the statement, sometimes we'll actually find that it's misleading. And that's with this example. There's studies done on missing the 10 best days, and they're always out there, and they'll tell you how horrible it is to miss the 10 best days. But again, I'll say, well, here's what happens if you miss the 10 worst days. So buy and hold the purple line over that 30-year window, 7.75% on average. If you miss the 10 worst days versus the 10 best days, your return skyrockets 37% a year. If you miss the 10 worst days, there's no way to time that or know when, how to miss those days. But it's still very easy to be misled. So I could easily turn around and say, well, what if you miss the 10 worst? It's way better. And that would throw that whole presentation upside down. And so missing both is pretty much the same as buy and hold. You're very close if you miss both the 10 best and the 10 worst days. So after being presented this over and over and over again, I decided to kind of look into it and just come up with a little piece to kind of prove that sometimes it's very misleading, that type of information, especially if you're not familiar with the investment markets. And so when you look here and you see, when do the 10 best days happen and the 10 worst days? And a lot of times you have to realize that, well, if you're having huge up days and huge down days, that's what we in the industry call volatility. Most investors hate volatility, and volatility is oftentimes is associated with a bear market. So, and that's exactly what I found. When you look here, the 10 best days on the left-hand side here, was October 13th, 2008, 9.81% was the best day out of a 12-year study. And then October 28th, 8.25%. But what did all these best days have in common? They all happened in a bear market. There's not a single one. There were 2008, 2009, and then also in 2011, which we had a 20% decline that year. So you're looking, you're going, well, I guess that doesn't really make a whole lot of sense because the market on average fell during this time period in 2008 to 2009 50%, but it had some of the best days. It had the best days in a 12-year period, and the worst days happened right alongside it. I mean, when you look there, 10/9 of 2008, the market fell 7.5%, which 3 days later, 4 days later, on 10/13 2008, it jumped 9.8%. So you can see it was just extremely volatile. And most people don't want to be in the markets during volatile times because their portfolio values are swinging drastically. So really, when you hear that argument, just remember what you heard here today, and be able to argue, I guess, your case that may be true. The statement is, it's not a lie, but it is misleading. So again, here's some bear market rallies over the 2000 period, and oftentimes they feel like it's a bull market. And so when you look at it, again, it kind of goes back to that 10 best day, worst day argument. When the market was selling off and you had all this volatility, a lot of your best days happened during that time period. And in here, when the market sold off drastically, a lot of times it became oversold and then began to rally. So you can see that oftentimes these bear market rallies, they feel like it's a bull market. But the trend of the overall market is still negative and down. And it is a secular bear market. So in 2001, you had a 20% return, over about a year period there, 24% return, 17%. But in all, the market started out at 11,722, and by the end of 2002, it was down to 7,280, which is about close to 50%. I'd say maybe 38% decline. So looking again here at the previous secular bear markets. This one goes back to the 66 to 82 period. That was one that was like a 17 year secular bear market. And oftentimes people get sucked into what the media is saying and talking about. And Alan Greenspan, January 4th, 1973, came out. He was the Fed chairman at the time and said, there's never been a better time to buy stocks. And that was exactly the worst time to buy stocks, because this was 1 week before a 45% decline took hold. And even when that happened, over that 2-year period, it fell 45%. The very next 2-year period, it rallied 75%. So you have to keep in mind the drawdown effect, which is pretty much, if you lose 50%, this is one that everyone understands. If you have $1 million account and it falls to 500,000, that's a 50% loss. How much does it take percentage-wise to break back even? It's 100% return. So as percentage-wise the market falls, it takes even more on a percentage basis for it to break even. So you can see over this 20-year period, I mean, there's several periods. The market fell at the very beginning there in 1966. Over a 9-month period, fell 25%. Then it rallied 32% for 2 years. Then it fell 36% over 18 months, and then rallied 66% over the next almost 3 years. And then plummeted again over half of its value, or close to half of its value, in another 2-year period. So really when people get caught up in this, they'll see the bull market start in their mind. It's up, just like the one in 1974, jumped 75%, and then they're just, oftentimes they get sucked in. They're instead of looking at the overall trend and what's going on in the economy and around the world, they get sucked into hindsight bias and to looking at past returns, thinking I've got to get in now. And in reality, you really need to look at things on a long-term basis. And another thing, analyst. I love analysts. I feel like I'm an analyst at heart. That's what I do. That's what I feel that I do best, is analyze different companies and securities. And this is like an actual example this is back in 2000. And the reason why I believe in technical analysis is not so much, to try to time the market. It's more of trying to identify trend changes within securities. And I always tell people, analysts will always be right eventually, because this is Amazon, fantastic company, but at this point in time it was way overvalued. Back in December of 2000, about December 28th, there was a technical warning, and the stock was trading at about $75. So it was over 100. So it's already backed off to 75. The technicals turned negative, which means warning, watch out. Let's value the company. Let's look at it. Let's dig a little deeper. But then by April, analysts were actually recommending to buy it, saying a strong buy and accumulate shares. And as the market, as it continued to fall, in their mind and in a lot of other investors' minds, that it's a better value now. But the thing to remember is, by the time it bottomed and there was a buy recommendation, the stock was under $20 a share, closer to about 10, before it actually took off rallying. But if you did invest on that first buy recommendation at around $70 a share, you rode that thing down, constantly being bombarded with this is a good investment. And that's just the media. I tell people all the time, turn off CNBC, shut off Bloomberg, and just focus on the numbers, and make up your own mind. Think rationally and analytically, and as opposed to, irrationally and just listen to what everyone else is. If you're listening to everyone else and you don't understand it, then you shouldn't be doing it. So another thing is mutual funds. I'm not a big fan of mutual funds. I think they're too expensive, and over long periods of time, I believe they erode people's wealth. That's just my opinion. I think there's some mutual funds out there that do well, such as fixed income mutual funds. It's such a broad market. I think that they can add alpha. But overall, I just think it's a glorified selling machine. It's a way to diversify. And back in, the 80s and 90s, it probably was one of the best things that you could do, because you could buy all these different companies. And at that time, portfolio turnover was, about 5 years, as opposed to now it's about a year. But I started listening to wholesalers. They would come into my office, always take us to free lunch, and to hear their sales pitch on their mutual funds and why they're great. And I started noticing that as I meet with these same wholesalers, quarter after quarter, they never came back with the same investment. It was, a different mutual fund every time. So then I got a hold of one of these charts that kind of shows by asset class, and then it all made sense. It was just like a light bulb went off, because every time, when you look at the top row up there, that's the best performing asset class during that year. This goes back to 88 to 2008. And so when you look there and you see, at the far left side, that emerging markets were up 40%. So I started thinking, this kind of makes sense. That would probably be the fund that the wholesaler or the mutual fund salesman would tell me was a great investment, that I should be investing my clients in this particular mutual fund. And then the next year, at 65%. But when you look at this, then you'll really realize that maybe not the best idea. 4 out of those 6 years, in 88 to 94, emerging markets was the best thing around, pretty much. 4 out of 6. But then for the next 5 years, it was the worst. And so you see all these bouncing around. Well, then it just made me realize that mutual funds have a mutual fund for every asset class. So they're always able to sell something. They're always able to, number one, take a hold of our emotional biases, which makes us look into the future. So if we see 40% in 1988 or a 65% return in 1989, we think that that'll happen again, and we do not want to miss out. So therefore, it's an easy way for them to continue to sell funds to people. And it's like, well, that one's not doing well, so you need to buy this one, so sell that one and buy this one. A commission turnover 5%. I mean, to me, it's just a vicious cycle. So diversification. Now, this is a double-edged sword, and I know I'll probably make some people a little angry, but in reality, in bull markets, the market's diversifying in a bunch of asset classes a lot of the times actually hurts portfolios. But portfolio diversification is great for people that really don't know exactly what they're doing, because it does help minimize some of the volatility of the portfolio, but it also minimizes the upside. If you minimize risk, you're going to minimize your return. So when you look here at this chart, I just put a bunch of asset classes together, and as you can see, it looks like it does okay over on the far left hand side. You can tell it kind of was spread out there, so some of these asset classes were actually boosting returns. But then if you just kind of pay attention to it over long periods of time, I always say diversification works until it doesn't, because in bear markets, correlations tend to move towards one. I know that's technical, but modern portfolio theory and the whole theory of diversification really boils down to correlation among asset classes, And so during bull markets or during sideways trends, a lot of times the markets are less correlated. But as people panic and people are just all piling into, run through that same exit door, correlations tend to move towards one, which means diversification, it doesn't do as well as people would like, especially in a bear market. So technical analysis, I know for a lot of people that that term kind of sounds like, well, I don't know. I mean, I've heard that you can't really time the market, but what I look for is actually trend changes. That's the key. The algorithm that I wrote is actually to help identify trends. It's not to try to time the top of a market or the bottom. And I always tell clients, I'll never get you out at the peak. I'll never get you in at the bottom. I'm just looking for trend changes to help minimize downside and try to capture as much of the upside as possible. So I use technical analysis, and my firm uses technical analysis to determine the trend. And what you try to do is you determine when it is changing, when it has changed, when to enter a position, when to exit a position. But the whole key, and the key that I think people don't understand, is you have to know when it's wrong, because that's the whole key. I mean, when you're whipsawed, trying to hang on to a position is actually detrimental to a portfolio. So that's one of the things when you look at an algorithm or look at trend analysis, the one thing that you want to keep in mind, yeah, you're determining when a trend has changed, but you've also got to know when it has reversed and the analysis or the trend is wrong. And then of course the key to it all is the trend must be identified early enough in order to profit from it. So you've got to determine that a trend has changed, be willing to take that position, knowing that you have an increased probability, or you hope you have an increased probability that this is a trend, an actual trend reversal, and then you've got to make sure that the trend lasts long enough. So all those keys in using trend analysis as part of your portfolio management. So the reason that we use technical analysis, of course, is something to believe in. It removes the damaging emotions of fear, hope, and greed. I mean, those are detrimental emotional decision making versus rational decision making. A lot of times this will actually help make rational decisions. It gives us discipline, and that's another thing that's key. Being a good investor requires discipline. When things don't work out the way that you think that they're going to work out, it still requires strategies, technical or tactical strategies, buy and hold strategies. They will all at times underperform other strategies, but the key to it is sticking to it, having a discipline, and moving forward. So I've studied behavioral finance for years, written articles on the subject, and one that I always recommend people to read, and I'll give it, just give our office a call and I'll give you a copy of it, and it's Beating Emotion. To me, emotion, more than risk, more than any other aspect of investing, is the #1 cause of underperformance and poor performance, is because we're not able to separate our emotions from rational thinking. So going in a little bit deeper, getting a little bit technical, this is the Advanced Decline Oscillator. This is something that I've created. A great friend of mine, Greg Morris, actually gave me a book years ago on market breadth, and that's what this actually measures, is the breadth of the market, which is the overall health. So I'll just make it very simple. The black line means that there's more people buying stocks in the New York Stock Exchange, which is 4,000 securities. The red line is declining issues, which means investors are selling those issues. So when the black line's above the red line, that means more people are buying stocks as opposed to selling them. And people go, "Oh, isn't that what the Dow Jones and the S&P tell you?" Well, not really, because they're market cap and price weighted. So a company like Apple, if it moves up 10% and every other stock is negative, the Dow or the S&P will actually move higher because Apple is a large company, so it has more weight in the portfolio. This is actually a breadth indicator, and what it does is it looks at everything on an equal basis. It doesn't matter whether it's a Sandridge now at 34 cents or a Berkshire Hathaway, at $200,000 a share. It weights them equally. All it measures is, are they buying it? Is it going higher or is it going lower? And then when you look at it over a long period of time, this goes back a couple of years, you can see this is not a timing indicator. It's just to determine the overall health of the market. So like I said, currently during this time period, this was in 2012 going into the end of 2012, you can see that there's a nice spread between those two lines, and that's just telling you the market's healthy. There's, equal distribution. A lot of people are buying, more people are buying than there are selling. So if you are going to buy and you have signals to tell you to buy, or your fundamental analysis tells you to buy, this is a good time to be buying. And here's the actual algorithm. Kind of looks funny when I made it a picture. It kind of, I don't know what it did. It kind of blew it up. But what it does is this actually it's math, an algorithm, and all it does is it looks at price change, looks at volume, momentum, and then it compiles all that and gives actual signals. And this is over, you have to look at that, the timeline down there at the bottom. I mean, this is a 2003 to 2015 chart. So whenever you see those signals and they look real close together, those are actually months apart. I mean, those that are clumped there in the end of 2009, 2010, that's, several months, maybe even 6 months there between those signals. But you can just get an idea of when we believe the market's bullish, when we believe the market's bearish, and we adjust our portfolios based on this. So you can see when the market's selling off, we get a bearish signal. This is just telling us the trend is likely changed, and if we have any positions, we'll look at those individually and chart those as well. So here's kind of like the approach of Paresis Private Wealth Management's portfolio strategy, and we kind of look at everything on I thought it would be easier to look at it kind of based on how everything works together. And we have a flexible portfolio design looking at individual stocks and ETFs. We manage, if we find individual stocks that are undervalued, we will actually purchase those individual stocks, and at the same time, if there is equity left over, what we do is index that, so we're able to capture some of the market's return, and then the individual securities are there to try to increase residual return or alpha. It gives us style freedom. We are a tactical allocation firm. We do not believe in buy and hold. We monitor our positions and portfolios for all of our clients daily. It's active portfolio management. And this gives us the ability that during market downturns or increased volatility, when our systems tell us to move, our rules, our discipline says we need to be in cash, or that's the best asset class, we have the ability to move clients' assets 100% to cash. And so we believe the need for tactical portfolio management is a lot of times buy and hold. You will suffer those big increases in large fluctuations in value over time. That's just part of it. Also, the drawdown effect because of volatility can deteriorate portfolios over time. We looked at that in the reverse dollar cost averaging. There's just several other things that we believe tactical strategies really benefit clients in the distribution phase as opposed to the accumulation phase whenever you're dollar cost averaging in. But these are just some of the reasons we believe that tactical portfolio management over long periods of times is superior. And that's it. I hope you gained an understanding of how we manage money, what we believe to be the best way to manage clients' assets. If you have any questions, feel free to reach out. Phone number. Also, just visit the website regularly. I'll try to keep videos and things, educational slides and things like that constantly updated on the website. And if you have any questions, just shoot an email. I'd be happy to answer those. And if you'd like to raise any questions, or if you'd like me to talk about something specific, or you have any other questions you'd like me to address through a commentary or video, yeah, just feel free to shoot an email or give me a call, and I'd be happy to do that. Thanks for tuning in, guys. We'll talk to you later.